Hello, I'm Vicky Hughes of Butler, Director of Private Client Services. The aim of this presentation is to go over some tax planning tips for individuals which could be taken before the 5th of April 2024. So the end of the tax year on the 5th of April 2024 will soon be here, meaning it's time to take a look at your plans and see what can be done to improve your tax position. The freeze on income tax thresholds and changes to dividend and capital gains tax allowances will see many brought into higher rates of taxation, but there are ways for high earners to reduce tax bills. We're going to cover some of our top tips for the upcoming tax year end here and what you need to do before it arrives. What can be done depends on individual circumstances and any business structures that you have in place. Please do remember that we're focusing on tax aspects here, and there is often an investment aspect as well. Tax is not the only consideration, and so it's important that you obtain financial advice as well, since as tax advisors, we cannot give investment advice. The aim of this presentation is to help you plan ahead and make the most of the allowances and choices you have. It should help you make sure you've made the most of tax incentives before the 5th of April deadline. So let's move on and look at some ways of reducing taxable income. There are steps that can be taken to reduce taxable income and therefore lower the overall tax bill for the current tax year that ends on the 5th of April. Remaining in basic rate tax band can help if you have children to receive child benefit without suffering the child benefit high income tax charge that applies to the higher earner over 50,000. Once you reach the higher income tax threshold, the amount you can earn in savings interest before paying tax is halved. Basic taxpayers have a £1,000 limit, but once you hit the higher rate tax band, you will see this cut to £500, which could result in extra tax of up to £200. Once you hit the higher rate of income tax, you pay higher rates of dividends tax and also capital gains tax as well. Anyone with dividends over the current £1,000 annual tax-free limit will be paying 33.75% tax instead of 8.75%. The capital gains tax difference is 10%. The tax-free allowance is also falling for both capital gains tax and dividends going forwards, making the impact even more significant. So now looking at ways of reducing taxable income, the slide here summarises some of the more common ways. So, for example, you can look at pension contributions, moving investments into non-taxable investments, giving to charity, passing income-producing assets to a spouse or civil partner who has a lower tax profile, or using tax losses. So these do show that there are various steps that can be taken to reduce taxable income and therefore lower the overall tax bill for the current tax year that ends on the 5th of April. Remaining in the basic rate tax band is what you're wanting to do, and it can help if you have children to receive the child benefit without suffering the child benefit high income tax charge that applies to the higher earner over £50,000 of taxable income. Once you reach the higher income tax threshold, the amount you can earn in savings interest before paying tax is halved. So basic rate taxpayers have a £1,000 limit, but once you hit the higher rate band, you will see that this is cut to £500, which could result in extra tax of up to £200. Once you hit the higher rate of income tax, you also pay higher rates of dividend tax and capital gains tax. Anyone with dividends over the current £1,000 annual tax-free limit will pay 33.75% tax on dividends instead of 8.75%. And for capital gains tax, the difference is 10%. The tax-free allowances are also falling for both capital gains tax and dividends going forward, making the impact even more significant. So let's move on to the next slide, which focuses more on pension contributions. So as the slide mentions, there's various different ways in which pension contributions can be made, and those made by an employer are tax efficient as there's no tax to pay, provided the annual allowance that you have is not exceeded. So it can be particularly helpful where the company is owned by the person receiving the pension contribution. It's often beneficial to all parties for employees to sacrifice some salary in exchange for a pension contribution made by the employer. This can help reduce national insurance contributions that are payable, but it isn't always as tax efficient for higher earners. Now, the rules on tax relief for pension contributions can be complex, and you need to make sure that the pension annual allowance tax relief is not clawed back. The standard annual allowance for pensions is £60,000 per tax year, plus any unused relief brought forward from the prior 3 years. And for personal pension contributions, once you reach the higher rate of income tax, which has the level of £50,270, you'll be eligible for more tax relief on your pension contributions, but often people are not aware that they need to claim it. And if you are in this position, the mechanism for doing this depends on the type of pension scheme that you're in. If you make personal pension contributions to a relief at source scheme, you'll need to claim the additional tax back from HMRC, and often many workplace pensions are set up this way. If this is you and you can claim some higher rate tax back, you need to submit a tax return to claim this additional tax relief, and claims can be backdated for up to 4 years. So if you realise that you should have been claiming some higher rate tax back in previous years as well, make sure you get your claim in as soon as possible before the current tax year ends. Finally, as the slide mentions, it is also possible to put money into children's pensions. In fact, anyone can pay up to £3,600 each tax year into a pension scheme, even if they have no earnings at all. In reality, this means that you can pay in a maximum of £2,880 a year, and the government pays in the additional £720 as basic rate tax relief to make it up to the £3,600 maximum that's permitted per year. This can be useful as it doesn't fall foul of the rules limiting what parents can give to children without parents being taxed on the income. And it does allow people to start having pension contributions made on their behalf as early as possible, and obviously then gives a number of years for it to accumulate. So moving on to some of the other ways of reducing taxable income that we've mentioned, this could be done by charitable giving. And in this regard, thinking here of gift aid, and if you are in a position where you pay enough tax, if you make sure that you tick the gift aid forms, that enables you to claim additional allowances as part of your tax calculations, and also the charity to get more as well. And then there are also tax efficient investments. On the side here, we've mentioned Enterprise Investment Scheme, Venture Capital Trust and SEIS, as well as ISAs. So as I say, there are a number of tax efficient investments. Some of these allow the investments to be carried back to previous years to accelerate the tax relief that can be obtained. For example, up to 100% of investments into qualifying EIS companies can be carried back to the previous tax year. A maximum investment of £1 million is permitted, or £2 million if it's in a qualifying knowledge-intensive company. And tax relief is available at 30% of the amount invested and can be carried back 1 tax year. Additionally, 50% income tax relief can be claimed on up to £200,000 in startup companies. Then moving on to thinking about ISAs, the income and capital gain within an ISA are not taxable, and sometimes they pay a lower rate of interest, but for higher rate taxpayers, this will often be balanced out by the fact that you do not have to pay tax on the money that's generated within it, and therefore it could enable you to stay below the higher rate thresholds, for example. Now, the maximum that someone over the age of 16 can put into an ISA is £20,000 per tax year. And so looking at these ISAs that are catering for people over 16, there are 4 different types. So there's cash ISAs, and they're for anyone over 16, stocks and shares ISAs, which can be held by anyone over 18, innovative finance ISAs that are for people over the age of 18, and lifetime ISAs, which can be had by people that are between the ages of 18 and under 40. It's possible to do the maximum into any one kind of these per tax year, and some of them are more flexible and have restrictions on when you can access funds, or you can split the £20,000 limit across all of them as you wish. But please remember that you can only put £4,000 into a lifetime ISA, and junior ISAs have separate limits as well. Then moving on to capital gains. consideration should be given to these, and there are a number of factors to think about before you decide to sell an asset and actually crystallise a capital gain. So some thoughts would be, should you look to crystallise the capital gains this year or next tax year? What's your level of taxable income, as that directly affects what rate of tax you'll be paying on the capital gains? Do you have any losses that have already been triggered, or is the potential that you could use some losses or crystallise some losses in the future? What timescale is it for having to pay the tax on the asset that you're disposing? Also, what's happening to the capital gains tax annual exemption? And are there any other things that you could do? So an individual currently has a £6,000 annual exemption, which if not used by the 5th of April is wasted and it cannot be carried forward. The annual exemption is reducing from the 6th of April, and then it will be just £3,000 per individual. Capital losses are automatically offset in the same tax year as any gains that are crystallised, even if that wastes some of the annual exemption. So it's important to think about the timing of what you're doing. And if you have unused losses carried forward outside the tax year, then they can just be moved forward. Be aware of whether you're likely to hit the higher rate threshold before you crystallise capital gains. If your income is temporarily higher this year, you could delay the gain until next tax year, and that would result in you paying lower rates of capital gains tax potentially. Alternatively, you might want to think about whether you're going to do a BED and ISA transaction. This is where you sell assets that you hold personally outside an ISA, and then repurchase them inside the ISA tax wrapper. It often makes sense to do this anyway if you've unused capital gains tax exemption in a tax year, regardless of what tax band you are. Because if you get the assets into the ISA, then they don't have any capital gains tax implications for you going forward. Also, if you do this between personal holding and an ISA, you don't fall foul of the bed and breakfasting rules and the 30-day matching rules, which would apply to you if you were just doing it in your individual capacity. Now, it is also possible to take the same steps if you have a SIP as your pension, or if you have a spouse and you want to affect what assets each of you hold. Now, moving on to another slide, which is talking about other factors which you might like to consider as part of your tax year-end planning. Other aspects can be significantly impacted if you go over £100,000 worth of taxable income. For example, tax-free childcare and additional free hours. Those opportunities are withdrawn if your taxable income is over the £100,000 level. Also, your personal allowance is tapered off if your taxable earnings are over 100,000. We can't go into all the details here, but it's often better to divert money into your pension, for example, to keep your taxable earnings below the 100,000, because there's an immediate cliff edge on the rate of tax that you pay. So if you were to have the opportunity of a pay rise, and that would take you over £100,000, it can actually leave you worse off by accepting it, because there's a marginal tax rate of income tax at 60% if your taxable income falls between the £100,000 level and the £125,140 level. Also, if possible, move investments that generate the highest income into your ISA first, so that you're protecting as much money from tax as possible, and it means that you're more likely to keep your taxable income below this £100 level. And finally, if your income goes over the 125,140 level, then the dividend tax rate goes up again. And so again, you're wanting to minimise the tax rates that apply to you. I'm conscious that there's various different things that have been discussed here, and it can only ever be at a very high level. So if you do have any questions about any of these aspects, or want to see if there's any steps that it might be sensible for you to take, please do not hesitate to get in touch, and we can see if there's areas that we can help you on. Thank you very much for your time.